Hi traders, welcome to this edition of Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30, 40 minutes or so. We'll follow the usual format, so we'll just check out how markets are started the week. Of course, we've had this big geopolitical news over the weekend in the Middle East to spice things up, and it's certainly a risk-off mood that has kicked off markets. Today, we'll look at that briefly, and then stocks, of course, see how they finished off last week and some of the technicals around the US major indices. Let's not forget we do have the start of the US earnings season, and some of the big banks out with their results on Friday. After that, we'll check out last week's main events, non-farm payroll, of course, and we also had some ISM survey data, quite important, as well as a couple of central banks, Australia, RBA and the RBNZ. So we'll just touch on those and look at the majors around those as well. So Aussie dollar, Kiwi dollar. Before then, looking at this week's main event, so US inflation data, of course, out on Thursday. We do have the FOMC minutes as well to look at. And as well, we'll touch upon UK data with the GDP out on Thursday. And we'll look at, of course, the DXY index and sterling against the dollar, so cable as well. Okay. Let's just crack on. First of all, we'll just check out how markets are shaping up currently. Of course, the big news is around that geopolitical news in the Middle East. Equity markets really around the world trading lower. Risk sentiment, as I said, taking a hit after Hamas's surprise attack on Israel. That triggered fears really that it may destabilize the region. Crude oil prices, and you can see the chart here, have jumped really with a focus on Iran, given its potential involvement, while gold certainly as well helped the bugs really, safe haven demand being seen in that. That said, of course, the moves in bonds and the dollar really slightly muted really. So far, markets also, of course, digesting that Friday mixed US jobs report, and China as well, of course, returning from its week-long holiday. We just have the chart here, as you can see, of Brent crude. Higher oil prices, of course, will add further support to the dollar in that they'll weigh on global growth. In fact, the IMF will probably lower global growth forecast this week, so that might grab some headlines. They'll also add to inflationary pressure, of course, and potentially as well drive this sort of wedge between those with oil sufficiency, self-sufficiency, that is, like the US, and then obviously those who don't have that luxury, being regions in, of course, Europe and Asia. All that said, it's probably too soon really to understand the extent of the conflict. In markets, there are reports, as I said, about Iran potentially helping Hamas plan the attacks. Apparently, they may have given them the green light. And then if this is proven to be true, I know already media reports saying Iran denies any involvement. But if this is proven to be true, really, then we could see the US, which is an ally of Israel, then taking a tougher stance against Iran. And that could ultimately lead to a reduction in oil supply and higher prices, of course, now and potentially further out into 2024. You've just got the chart here. You can see the big run up from those sort of June, mid-July lows above 30% in a few months. And then we've had that quite sharp decline very recently last week. I think interesting, if we do push up on prices sort of $87 or so, if we do push up, then you've got that high to contend with around $88 from that previous high. You can see there the dotted line. Of course, we got up to where 95.31, the high. And of course, there were calls around here for a push towards $100 a barrel. I think quite a few oil experts really calling that potentially a tough barrier to beat, because essentially Saudi Arabia could unwind their additional voluntary supply cuts, really as they could get concerned around demand destruction. And that's the key for prices as we go higher, potentially in oil. And as I said, around $100, then Saudi Arabia certainly could get worried about that idea around about demand destruction. We also have big elections next year to think about. So elections in the US and India. So potentially you get more political pressure put on OPEC plus, put on Saudi Arabia as prices rise in crude. So that's the oil chart. Let's get to equities now. And first of all, the S&P 500, just pull up a weekly chart here. They were lifted on Friday, actually, by that combination of apparently stronger employment demand combined with a kind of nuanced view on the prospects of further Fed tightening. The S&P actually rose 1.18% on Friday. The Nasdaq put on 1.6%. Futures, of course, they've turned lower today. Just checking, sort of down 0.5% or so, slightly higher in the Nasdaq. Interesting, I think, as well, actually, just before we look at these sort of technicals, last week's VIX index, that's basically Wall Street's fear gaze, that before today's activity last week, it did move aggressively up towards 20, only then to pull back below 18 on Friday. It pretty much ended up where we where it took off on Monday, last Monday, that is, around 17.5 or so. So that really showed that the week was volatile, but effectively didn't really move that much. Now we're back above 19, just a touch above 19. So, of course, shows near-term volatility will be present in the week ahead, which is interesting, of course, with the Middle East issues going on. I did mention, of course, we do get as well the US earnings season kicking off later on in the week. We get JP Morgan, Citibank, and Wells Fargo will be a key focus on Friday. It's really a big question, really, how US banks cope with that these sharp losses in US treasuries that we have seen, of course, will be of interest following the failure of 3 US banks in March. Just specifically on those stocks, JP Morgan really has outperformed most of its peers after benefiting from the regional banking crisis in the US in March. And then certainly as well on some of the turmoil that we have seen in rates markets with surging yields. Flip side, seen Citibank struggle. That's been one of the least profitable US banks. So there have been big plans, of course, to correct that potentially. So it'll be interesting to see whether results reflect that. And then Wells Fargo, generally considered a sort of bellwether of the US consumer. It's one of the largest US retail banks and mortgage lenders. So there will be some attention on the bad loans coverage potentially, as consumers get hit by, of course, high inflation still and higher borrowing costs. So those are 3 banks to watch out for in the US. Just on the technicals, then we can see this sort of long-term trendline support really holding prices really quite interesting. If I just take out, well, you can see the trend line here. Let me just probably make it a touch bigger. You can see that trend line there, and we've sort of dipped below it, but then pulled back and moved higher last week, certainly. So that's interesting. Whether that keeps hold, you can just see it there as well. Otherwise, yes, we're moving up towards some fib levels around 4,300 or so. So that would be first level of resistance. We've then got the 100-day moving average at just below 4,400, and then the 50-day moving average just above 4,400. So that'll be a level for bulls to look to get towards. You can see the 200-day moving average. We didn't quite tap that, just around sort of 42.08 now currently, and we just got sort of below, just above there above 4,200. So interesting level of support there, as well as that trend line support, long-term trend line support from those previous lows. That's the S&P 500. Just looking at the NASDAQ, we can see again that sort of trend line. Yeah, we're above it again. So interesting whether that holds. You've got the fib level at 14,700 or so, just below there. So really we need to push up towards these sort of levels around sort of 15,000, 15,500 potentially, to have a look at sort of the recent highs. Interesting. Otherwise, the recent low probably around 14,432, and that previous low from August around 14,500 or so. That's probably major support. If we do roll over, then through that, then we're going down towards sort of below 14,000. That is the NASDAQ. Just on the Dow, we can see the weekly and that sort of candle where we've dipped below 33,000, but then sort of closed near the highs, but still a down week. That's the third consecutive week of losses. Haven't seen that actually since, interestingly, since February. So interesting, but quite a positive candle, really. We closed above or close to the highs after dipping down below 33,000. Certainly, then we've got the 100-week moving average and the 50-week moving average to contend with before then, 34,281. We've still got that in there as a heavy line of resistance. You can see that there. Closer to home as well, you've got the 200-day moving average at 33,803. That will be an interesting initial level of resistance in the Dow. Okay, let's go to last week. And first of all, non-farm payrolls, of course. Let me just get up bear with me. First of all, the graphic that we like to show you, which is here. You can see the main numbers. Headline payroll figure, of course, 336,000, well above the 170 expected. And there were sizable upward revisions of 119,000 for the previous 2 months worth of data, around 40,000 in the August one from 187, I think, to 227. Quite a surprise, really, as the ISM reports didn't really suggest anything like this would happen, nor did some of the other employment surveys, and certainly not the ADP number, although I know some economists are citing that now as a sort of, that has an inverse correlation to NFP. But a mixed report in some senses. Average hours worked were flat on the previous month, and household survey of employment actually showed a much smaller increase of only 80,000 jobs and a rise in unemployment of 5,000. The positive side was the average hourly earnings growth. That slowed a little to 4.2% from 4.3%. And then that 0.2% month-on-month increase was 1/10 below estimates and the previous, I think. Unemployment, that remained unchanged at 3.8%. But there was broad strength, really, with hospitality and leisure leading the way. It all leaves the 3-month average, I think, at around 240,000. So that's really quite decent still, given the strength. We will likely see that in third quarter GDP. I think economists now saying they wouldn't be surprised to see a 4% annualized expansion, with some of those factors like the Taylor Swift, Beyonce concerts, Barbenheimer as well, sort of adding to give growth a kick higher, really. So GDP expanding really quite, as I said, decent pace. Markets, though, they sort of seem to take a sort of balanced view of the data rather than moving only in one direction, which with that headline number, you would probably have seen yields move substantially higher. The Doves probably citing the trending higher of unemployment, the longer term trend that is, and then the subdued wage print. But then the Hawks on the other side will say that demand for labor remains much stronger than what is needed for inflation to sustainably return to the Fed's target anytime soon. Yields, as I said, they initially jumped higher on that outside headline payroll beat. The 10-year yield actually touched a new intraday cycle peak at 4.88%. However, it's probably one step too high to force a sustained break going into this long weekend, US weekend, that is. And yields actually closed well off their intraday top levels. Let me just pull up that chart. We like to show you that from time to time, which is the US 10-year Treasury chart, which is here. So just bear with me 1 second. I'll just pull that up, which is just here. So you can see, where are we? 10-year chart. Just bear with me 1 second. This is the weekly chart, and you can see it's getting up to 4.88%. As I said, that was last week before pulling back. And then on the daily chart, yeah, you can see the high at 4.88%, and then we closed actually down at 4.8%. So that was the move in treasuries. Interesting, futures markets kind of roughly pricing in around a 40% chance of a 25 basis point hike this year. That was up roughly from sort of 35% a day earlier. And stocks, they actually did well. Should have pointed that out, really focusing on probably more the economic resilience, possible soft landing theme as well, which could, of course, then spark optimism around or about future corporate revenues and profit growth going forward. So that is the 10-year Treasury yield. I just think we'll look at the DXY shortly, actually, when we go into US CPI. Just other data to point out, US ISM manufacturing and services data we got last week. We saw an upward surprise in the manufacturing data, to 49 from 47.6. Consensus was 47.9. That was actually the third consecutive increase, with the headline number matching the highest net level since November 2022. Potentially then that's showing a bottoming out pattern in manufacturing, and the details were fairly decent as well. That again brought around sort of those soft landing idea feelings as well, which is, of course, is the Fed's preferred scenario. So interesting data there. And then the services data, well, that was in line with consensus, falling from the month before. It showed a modest slowdown across really all survey measures, which, however, stayed well into expansionary territory. So that's above 50. If you remember, that's the boom bust line. Interestingly, there is an ongoing contrast actually with the S&P PMI numbers, which supposedly ask the same question to the same pool of companies, but it indicates flat activity as opposed to ISM's more upbeat 53.2. So just bear that in mind going forward. So that's the main data from last week in the US. Just touching on the RBA announcement and the RBNZ announcement. They were last Tuesday, last Wednesday, last week. Just on the RBA, it was obviously the first meeting presided by Michelle Bullock as the governor of the RBA. They kept rates unchanged at 4.1%. Actually, I'll just pull up the graphic for you. Just bear with me 1 second. Which is here. Before we look at the Aussie dollar, yeah, you can see the sort of main numbers. We showed you this actually last week with the preview, but it also stands for the review of that meeting. Yeah, rates kept unchanged at 4.1% for a fifth consecutive month. RBA really assessed that higher interest rates are working to establish a more sustained balance between supply and demand in the economy, and will continue to do so. Given a higher degree of uncertainty on future developments, really the RBA is maintaining this sort of wait and see data dependent stance for now. It does see goods price inflation easing further, but prices of many services are continuing to rise, and fuel prices have risen noticeably of late. Rent inflation also remains elevated. The RBA held its assessment of CPI, falling back to that 2 to 3% target range in late 2025. So their view is kind of rather benign, reinforces that consensus view that the tightening cycle is over. for the RBA. I think markets pricing around sort of 8 basis points or so of rate hikes by December, so around a 30% chance or so. But that consensus view really is that tightening, as I say, is over now. Just looking at the Aussie dollar, which is here, you can see really hit by sort of crosswinds of higher US rates on the one hand, and then deteriorating risk sentiment, of course, highlighted with today's move lower, and also then China sentiment, of course, still being fairly subdued. Yeah, so we've moved out of the sort of 66, 68 range. You can see down to a sort of maybe a 60, 64, 65 range potentially. But of course, we did dip below 64 down to what, 62.85, 62.86 now were the lows from last week, but we've just sort of pushed above that in the latter part of last week, especially on non-farm payroll, where the dollar sort of gave back those gains, and you can see Aussie dollar sort of pushing higher back towards 64. So let's blow that up slightly. Interesting, yeah, we are down today, but not off. Well, we're off the lows in the Aussie dollar. So whether we can keep above the sort of 63 level will be key for the Aussie going forward. Just on the RBNZ then as well, they similarly, well, they maintain the cash rate at 5.5%, as widely really anticipated by both markets and consensus. While risks to the growth outlook were seen as balanced, the overall tone actually in the press conference was slightly to the dovish side, and that surprised markets really. RBNZ, they kind of maintain their forward guidance, signaling that rate hikes are most likely already over, but the rates would remain at restrictive levels for a more sustained period of time. As I say, markets have or had speculated with a modest chance of RBNZ returning to hiking going forward. So as I say, the guidance was a slight dovish surprise, and that caused the Kiwi to decline following the meeting, which you can see there, that Wednesday candle where we dipped down to 58.70, but then closed slightly higher on the day as the dollar really moved lower, and that helped the Kiwi and, as I said, the Aussie as well. So interesting, we're sort of staying above the 59 level really, and that low sort of 58.70 didn't quite challenge the lows at 58.59 or so. So strong level of support around that mark, that zone really, and we're just now we pushed above 59, heading towards 60. Interesting, that's the 50-day moving average. If we can keep above that, then potentially we're looking towards 60 or so in the Kiwi dollar. Okay, this week, let's get to the main event, which is, of course, the US CPI data. Just pull up the preview. This should be a preview, not review, not just yet, but a preview of the US CPI data. That's out on Thursday. Headline consumer prices expected to rise 0.3% in September. That's half the rise seen in August and in line with the average for the year to date, really. That leaves the annual at 3.6%, which is a tenth lower than the 3.7% in August, but still some 0.6% above the recent low in June. The core then, that rate is seen expected to rise 0.3% against the previous 0.3%. Or so, with the annual falling to a 2-year low of 4.1% from 4.3% previously. The upside in gasoline prices is likely to support the headline, along with higher food prices, but then economists say underlying price growth, so that's the core, is expected to be more benign, with slowing rents potentially now having more of a cooling influence. That's on the core number as opposed to the headline, which is affected by, of course, those energy costs, the gasoline prices. Going forward, then, it appears likely that while inflation pressures will continue to ease through year end, certainly the moderation will be bumpier than it has been over the last year. And that's particularly true, as I just said, for headline, where, of course, energy prices will affect that and possibly contribute to upward pressure in the near term. Just remember, of course, we do highlight that policymakers really want to see the core month-on-month around 0.2% for a protracted period to then bring down inflation closer to its target. All the data, of course, will be framed around or in the context of Fed policy. Any upside surprise, especially in the core, will likely tilt the market's implied path in a hawkish direction and fuel again another leg higher in the dollar. Flip side, any downsides relative to consensus will likely see markets continue to price the path of future rates more dovishly than the Fed's current dot plot, which sees one more 25 basis point rate hike this year, and that would then keep rates at 5.25% to 5.5%. Let's just pull up the dollar DXY chart just to show you. Still bid on today's geopolitical news, of course, and you can see that really strong uptrend, series of higher highs, higher lows from those lows below 100 in mid-July. Now, well, that high was above 107, 107.34, and we just dipped below there the last few days until today's news, of course. So we're still in the uptrend, still in the bull channel, and for sure then 107 and 107.17 and 107.34 are key levels for upside, $4 bulls. You can see if we just pull back actually on the weekly, I've got these fib levels in here. And they are the halfway point of this decline is at 107.17. Let's just pull it up. Actually, the next level would be the 61.8, which would be at 108.97. So quite a lot higher. Interesting for us is, well, these 11 straight weeks of gains. We've highlighted that over the last couple of weeks. And it is very rare you get these double-digit runs in major currencies, and that has been difficult to sustain, and it was not sustained actually last week. And interesting, we got this candle here, which if we just blow it up is basically a shooting star candle, so a bearish reversal candlestick potentially, although we're not seeing that today, of course. You can see it has a kind of small body, but then a long upper shadow. And then small or absent lower shadows closing near the lows. But at the moment, that's not quite working. Let's just get to the daily. Again, you can see the channel still holding out the bull channel. And as I said, I pointed out the levels above around 107 and above that. So that's the DXY. Otherwise, we have... what do we have? We have UK data, finally. Just pull up the cable chart, which is a bear channel. We have UK data on Thursday. That's GDP. That's the main focus for the UK, as I say. Monthly GDP for August. Survey indicators, including PMIs, kind of signaling a deterioration in economic momentum over the summer. The composite index slumped to 48.6 in August, so a level that in the 5 years before the pandemic would have been consistent with really substantial contraction in GDP. This time, we may get some positive payback for the weather-associated weakness we saw in July. That saw a GDP decline of 0.5% month on month. And well, retail sales, they reversed some of their decline. So overall, consensus expects GDP to have risen 0.2% month on month in August. That leaves growth on a 3-month basis moderately positive at 0.3%. And that would actually be the firmest in 13 months. And certainly, I think the absence of strikes by teachers and doctors ought to act as support. And then from a policy perspective, well, from a Bank of England's perspective, unlikely really this release to do much to sway investors from expecting an unchanged rate decision from the bank in November. After, remember, the MPC opted to stand pat on rates last month. And with the recent upside we've seen in yields having further tightened financial conditions in the interim, then that is probably the most likely decision we will get in November. Standing pat, we don't get much data apart from UK CPI and wage data next week. So that will be key for the decision. But you kind of think if they stood pat as well previously, when potentially we were expecting one more rate hike, then that looks unlikely unless that's data. We see a massive upside surprise in that inflation data and wage data, which is key for the MPC. Otherwise, for cable, well, we had 3 days of gains. Welcome, really. Haven't seen that since sort of, you can see, late August, probably down to some bargain hunting and position adjustment, rather than certainly any fundamental developments. We did have Wednesday, you can see, if we just show you that, a bullish outside candle, and then these consecutive days of gains. But otherwise, we're still in this bear channel, descending, of descending prices, really. Cycle low at 120.37, and really we need to get above sort of 123, and then towards 124 to get out of this channel. Top side just below 124, and then you've got the 200-day moving average of 124.39. So pointing to still lower prices, down towards 120 in cable. Okay, we'll wrap it up there, actually. Shorter than normal, but hopefully that's proved of some use to you guys. Great to have you on the call. And actually, just before I depart, I do have the chart of US CPI. Sorry, I forgot to show that a few minutes ago. So you can see decline in prices there, and that disinflation trend expected to sort of continue in the core number, as I said. Just briefly, actually, just before we wrap up, sorry, we do have the FOMC minutes as well. Sorry, I've skipped those for some reason. That meeting, the Fed voted unanimously to keep rates at 5.25%, 5.5%. But they upgraded, if you remember, their language about the economy, and then they updated their economic forecasts more hawkishly, and then the dot plot was revised hawkishly as well. They kept that hike for this year, of course, and then next year they only see a prospect of 50 basis points of rate cuts versus 100 basis points in the previous dot plot. During then the press conference, Fed Chair Powell, he did emphasize the cautious approach, but he also suggested the neutral rate may have risen in the short term, contributing to the economy's resilience. Overall, the message was sort of cautious optimism, really, and eyed on inflation and willingness to adjust policy as needed. But then the updated projections were sort of quite surprisingly hawkish, quite bullish, and there has been then a lot of skepticism around those forecasts. Really, because I think most economists, especially, are predicting a mild recession or near recession to be the most likely outcome. And certainly the outlook, if we do get rates higher for longer, potentially then the real economy will be considerably weaker. And regardless, core inflation will then fall back to target much more quickly. That's probably the key takeaway, a slight difference, really, even though markets are pricing around 30-40% chance now of another rate hike. So the majority still, or 60% chance rates stay where they are, which is in contrast to that dot plot, which still shows one more hike for this year. Highlights this week, we do get a host of Fed speakers, but of course that CPI data will be key for markets going forward, whether it moves up those Fed funds futures towards the chance of a rate hike or not. Okay, do follow us, please, on social media. And also, we do have a daily commentary on the website. Yeah, take care out there. A lot of data and, of course, the geopolitical news to contend with. So we'll speak to you same time next week.